Welcome to a special Talk Tickers format deep dive.
Glad to be here.
So if you're a regular listener, you know our usual mission. We try to cut through all the Wall Street jargon and deliver a, super fast-paced, data-forward breakdown of an earnings call.
Right, usually in under 5 minutes.
Exactly, under 5 minutes, hitting just the absolute most important takeaways. But today, we're looking at AMETEK Inc., ticker symbol AME. And honestly, their Q4 2025 earnings call just has too much meat on the bone for a 5-minute sprint.
Yeah, there's a lot going on under the hood right now.
I mean, we're seeing massive M&A integrations, a huge pivot into AI infrastructure, and all of this is happening while the broader industrial economy is just, well, it's sluggish, to put it nicely.
It basically flashing recessionary warning signs everywhere else.
All right, so we are expanding the lens today. If you're holding this stock or, even just watching the industrial sector, we need to extract the exact reasons why AMETEK is defying gravity right now.
Because they really are. It's a complete divergence from the macro narrative.
So here is the framework for today's deep dive. We're going to hit 4 pillars. First, the headline numbers.
The hard data.
Yep. Then the story behind those numbers, like what's actually driving the growth. Third, we'll look at management's guidance for 2026.
Which is fascinating, by the way.
It really is. And finally, the bottom line. Is this a bullish or bearish signal for your portfolio?
Spoiler alert, we have a pretty strong opinion on that.
We definitely do. Okay, let's unpack this. We are diving straight into the hard data. Let's look at how AMETEK actually performed against expectations.
And the headline here is just, well, it's massive. Q4 sales hit a record $2 billion.
$2 billion in a single quarter.
Yeah, which is a 13% increase year over year. For a specialized manufacturer, crossing that $2 billion mark is a huge psychological threshold.
It really is. But I want to break down that 13% growth because, it's not all just organic growth.
Right. The mix is super important here.
So I've got the numbers right here. Organic sales were up 5%. Then acquisitions added 7% to the growth.
And currency exchange rates threw in about 1% as a tailwind.
Exactly. So more than half of their top line expansion in Q4 came from buying other companies, from inorganic sources.
Which, for a lot of industrial stocks, if you see them buying their way to growth while the core business shrinks.
Total red flag.
Massive red flag. Usually means they're trying to hide a dying core business.
Mm-hmm.
But here, they've got 5% organic growth in this specific contractionary environment. That is incredibly robust.
Yeah, the core engine is definitely healthy. And you really see the power of that organic growth when you look at the earnings per share, the EPS.
The adjusted EPS came in at $1.95.
Right. And I have to mention a quick accounting nuance here because standard stock screeners might get confused by this.
The tax rate thing.
Yeah, the CFO called this out. In the prior year, Q4 2024, they had an abnormally low tax rate. So if you adjust for that anomaly to give us a true apples-to-apples comparison,
their EPS effectively increased by 11%.
Exactly. 11% EPS growth on 5% organic revenue growth. And for the full year, EPS hit $7.43, up 9%.
This is a textbook example of operational leverage.
Let's translate that for the listener. What does that actually mean in plain English?
Sure. So operating leverage just means that for every new dollar of sales they make, a much bigger chunk of that dollar falls straight to the bottom line as pure profit.
Because all their fixed costs, like the factories and headquarters, are already paid for by their baseline revenue?
Right. So the cost of making that next widget is just raw materials and direct labor. When they push a 5% sales increase through the system, the profit jumps by 11%.
It's beautiful to watch, and it shows up directly in their margins. Operating income hit a record $523 million. That's up 12%.
But the margin percentages are where we really need to dig in. Because they reported operating margins of 26.2%.
But then they went out of their way to say, wait, our core margins are 27.6%.
Yeah, a robust expansion of a full 100 basis points, or 1%.
And their EBITDA, so earnings before interest, taxes, depreciation, and amortization hit a record $618 million, with a 30.9% margin.
Yeah. Maintaining an EBITDA margin over 30% in heavy manufacturing is just, it's practically unheard of.
It's like a software company's margin.
Exactly. Applied to physical, mechanical goods.
But wait, I have to push back here. Look at that gap between the reported 26.2% margin and the core 27.6%.
The 140 basis point gap.
Yeah. I mean, why the gap? Whenever I see adjusted or core numbers, my radar goes up. Are they just hiding bad performance behind adjusted spreadsheets?
It's good to be skeptical. Companies do love to adjust away their mistakes. But here, it's highly defensible. It's strictly mathematical.
How so?
It's because of their recent acquisitions. Specifically, they bought a company called LKC Technologies.
Right, along with Kern Microtechnic. They dropped about $1 billion on those two.
Yeah. And when they bought LKC was not running at 30% margins. They were operating in the mid-teens, around 15%.
Ah, okay. So if you have a massive $2 billion business running at 30%, and you bolt on a new business running at 15%.
The blended average of the two mathematically drags the total reported margin down.
Got it. So that reported 26.2% is the honest mathematical reality today. But the 27.6% core number proves their base legacy business is actually getting more profitable.
Exactly. It proves the underlying engine hasn't lost a step.
Okay, but if I'm looking at this as an investor, I still have to ask, why buy a margin dilutive business? If your engine is running so efficiently at 30%, why throw a heavy 15% asset into the mix?
Well, think of AMETEK like a master corporate flipper.
Okay, I like that analogy. Like flipping a house.
Exactly. A professional flipper doesn't buy a pristine, move-in ready house at the top of the market.
Right. They buy the solid house with the terrible wallpaper and bad plumbing.
They buy it at a discount, strip it to the studs, apply their proven renovation playbook, and dramatically boost its value. AMETEK is doing exactly that with these mid-teen margin companies.
So they buy a company like Faro, strip out the public company costs.
Yeah, Faro had its own board of directors, investor relations, all of that. AMETEK eliminates all those redundant costs on day one.
And they apply their operational playbook. In fact, didn't they aim to double those EBITDA margins to 30% within 3 years?
They did. The CEO stated that explicitly. They even took a $17.6 million restructuring charge in Q4 just to fund Faro's integration.
Okay, so that covers the margin story, but let's talk about cash, because profit on an income statement is just an accounting concept, right?
Cash in the bank is reality.
Exactly. And their free cash flow was insane. A record $527 million in the quarter.
With a 132% conversion rate from net income.
132%. For retail investors listening, if you want a litmus test for earnings quality, this is it. It means for every dollar of net income they claim, they are actually generating $1.32 of physical cash.
It's incredible cash generation.
Yeah.
And they ended the year with a record backlog, too.
Right. $3.58 billion in backlog. And a book-to-bill ratio of 1.02.
Meaning they are still taking in more new orders than they are shipping out, even while shipping $2 billion in a quarter.
It's easy to look at a record $2 billion top line and just cheer. But to understand if this is sustainable for your portfolio, we have to look under the hood at the specific divisions driving this growth.
Yeah, because it's not a monolith. When you look at the segment breakdown, it's essentially a tale of two different economic cycles.
Let's jump into the second pillar, the story behind the numbers. The divergence between their two main groups is wild.
You've got the Electrical and Mechanical Group, EMG, and the Electronic Instruments Group, EIG.
EMG was the absolute star. Sales were up 15% to $629 million. But the crazy part, organic growth was a massive 14%.
Almost all of that growth was internal, not acquired.
And their operating margins jumped 240 basis points to 22.7%.
14% organic growth in heavy mechanical components while global manufacturing is contracting is a massive anomaly.
But then you look at EIG, the Electronic Instruments Group. This is their bigger segment, their higher margin segment. Sales were $1.37 billion, up 13%.
But organic growth was much softer, 2%.
Just 2%. The rest was all M&A. So if I'm an investor, I see 2% organic growth in their flagship segment, and I'm thinking, is demand drying up? Are customers delaying capital expenditures?
Analysts were thinking the exact same thing. They pushed management really hard on this soft print during the Q&A.
Right, but the CEO's response totally recontextualized it.
What's fascinating here is the cyclical lag. The CEO explained that this 2% isn't a story of a business slowing down. It's a business actively recovering from a trough.
Because earlier in the year, EIG's process businesses were actually printing negative growth.
Exactly. They were in an active contraction.
Yeah.
But by Q4, They finally crossed back into positive territory, low single digits. So 2% isn't the ceiling, it's the floor they're bouncing off of.
And historically, EMG, the mechanical side, always picks up first in the cycle. The process businesses in EIG follow a few quarters later.
So that massive 14% growth in EMG is actually a very bullish leading indicator for EIG going into next year.
That makes so much sense. Now let's talk about where they are selling these products, because their geographic and end market strength is another huge part of the story.
Their portfolio positioning is highly defensive. Look at their medical portfolio.
Yeah, medical now makes up roughly 21% of AMETEK's total business, driven by acquisitions like Paragon Medical.
And medical is completely insulated from industrial boom and bust cycles. If you need a joint replacement, the hospital orders the implant. It doesn't matter what the Fed is doing with interest rates.
Totally. It provides this incredible recurring revenue base. And then geographically, this blew my mind. Asia was up 10%.
And China was up low double digits.
Which is wild. All the headlines about China right now are about deflation, real estate collapse, consumer confidence crashing. How is AMETEK posting low double-digit growth there?
Because they aren't selling consumer goods. AMETEK sells highly specialized tools for advanced manufacturing. Automation sensors, EV testing equipment, emissions monitors.
Oh, the exact sectors the Chinese government is heavily subsidizing right now.
Exactly. They are selling the high-margin picks and shovels to the industries China is prioritizing.
Okay, so to keep this engine running, they need a constant M&A pipeline. They deployed $1.8 billion in capital in 2025, and they just announced a new one, LKC Technologies.
LKC is a perfect bolt-on acquisition. They make portable ophthalmic tech, mostly for detecting diabetic retinopathy.
But the real kicker is the business model, right?
It's the razor and razor blade model. The portable testing device is the razor. The proprietary sensor strips you have to put on the patient's eyes for every test are the razor blades.
Which means 40% of LKC's revenue is recurring.
As an investor, recurring revenue is the holy grail. It gives you incredible earnings visibility.
So they've got this great M&A engine, but what about the legacy business dealing with inflation? Everyone complains about supply chain costs and tariffs.
Management flatly confirmed a positive price-cost spread in Q4.
Meaning they successfully raised prices to completely offset all inflation and tariff pressures.
Not just offset them, they actually expanded their margins by 50 basis points through pricing alone.
It's wild. It shows incredible pricing power. If you make a critical component for a fighter jet or a pharma lab, the customer isn't going to switch to a cheaper competitor just to save a few bucks. The switching costs are too high.
Exactly. They're selling certainty, and customers will pay a premium for that.
All right, a master flipper relies on future inventory to keep making money. So what exactly is management saying about the year ahead, and do they have the cash to keep buying? This is Pillar 3, management guidance.
For 2026, management expects overall sales to be up mid to high single digits, with organic sales up low to mid single digits.
And EPS guidance for 2026 is $7.87 to $8.07, so a 6 to 9% increase.
Which looks like steady compounding growth, but the Q1 specific guidance caused some friction.
Right. Q1 sales are expected to jump 10%. But EPS is guided between $1.90 and $1.95.
Which implies a slight year-over-year dip in profit margins on a reported basis.
Which makes no sense initially. We just talked about their massive pricing power and positive price-cost spread. Why would margins compress in Q1?
Because of the Faro acquisition we talked about.
A flipper analogy again.
Exactly. You're absorbing a full quarter of Faro's 15% margin business against that 10% top-line growth. It mathematically depresses the reported margin.
But the core legacy margins.
The CFO clarified that core margins are actually expected to expand by 30 basis points in 2026. The underlying engine is fine.
Okay, that makes sense. But I still want to push back on their organic growth guidance. They are guiding for low single-digit organic growth in the EIG process segment for the year.
Right.
But December was literally a record month for orders. They have a record $3.58 billion backlog. The global PMIs are turning positive. Isn't low single-digit guidance overly cautious? Are they sandbagging?
I wouldn't call it sandbagging, but the CEO used the word prudent. AMETEK's management is famously conservative early in the year.
So they'd rather set a beautiful bar than overpromise.
Exactly. With all the geopolitical uncertainty and volatile interest rates, they want a target they know they can hit, even if the macro environment seizes up again.
Fair enough. Now, let's talk about the most exciting part of their guidance, the war chest.
AMETEK has over $5 billion in capital deployment capacity.
$5 billion, all while maintaining an investment-grade credit rating. Their gross debt is just 1 times EBITDA.
That level of leverage is incredibly conservative for an industrial conglomerate. It gives them total financial sovereignty.
So even if interest rates spike tomorrow, they aren't crippled by debt service costs. They can just use their cash to buy distressed competitors.
And management stated they have an unusually strong pipeline of larger, high-quality M&A deals right now.
And they have an internal dedicated M&A team of 11 people to execute it, which sounds small, but it's actually a massive internal strike force compared to relying on investment bankers.
And the operators of the business units have to sign off on the financial targets before a deal closes. They own the integration from day one.
It's a brilliant system. Okay, we've got the data, we've heard the story, and we know the guidance. Now let's synthesize this into actionable intel for you, the retail investor. Pillar 4, the bottom line.
And we are taking a definitive stance here. This earnings call is a highly bullish signal.
Extremely bullish. We've distilled why it's bullish into 3 actionable takeaways. First, defensive pricing power.
They prove they can entirely offset inflation and tariffs through strategic price hikes without losing a single point of volume.
If you hold AMETEK, you don't have to worry about raw material inflation eroding your bottom line. They just price it through.
Second takeaway, M&A optionality.
Right. With that $5 billion war chest and almost 0 net debt, they are perfectly positioned to literally buy their own growth, even if the broader economy stalls out.
They are a capital allocation machine. But the third takeaway is arguably the most exciting.
Internal momentum and the vitality index.
The vitality index completely recontextualizes how you view this company.
Let's explain what that is. The vitality index measures the percentage of sales generated by new products introduced in just the last 3 years.
And AMETEK hit a 30% vitality index in Q4.
Think about that. 30% of their $2 billion quarterly revenue comes from products that did not exist 36 months ago.
For an industrial manufacturer, that is venture capital level velocity in their internal R&D.
And they are aiming that R&D at massive secular growth markets,
Right.
like data centers and grid modernization.
Right. The AI boom is constrained by power and thermal management. AMETEK is selling advanced liquid cooling and microgrid stabilization tech straight into that ecosystem.
So what does this all mean?
It means if you're looking for a compounder that generates cash, relentlessly remember that 132% conversion rate and knows exactly how to deploy it. This quarter proves the thesis is fully intact.
Let's wrap up this deep dive with one final provocative thought for you to mull over. We just talked about their 30% vitality index. We see deeply integrated software in their metrology units and advanced cooling solutions feeding the AI data center boom.
Their revenue base is looking incredibly sophisticated.
Exactly. So my question is this. Is it time we stop valuing AMETEK as a traditional slow-moving industrial manufacturer?
And start looking at them as a stealth, high-margin technology company.
Right, because if the market starts applying a tech multiple to AMETEK's cash flow instead of an industrial multiple, the valuation could look radically different. Thank you for joining us on this Talk Tickers deep dive. Question your portfolio allocations, look at the data, and we'll catch you next time.